Thanks so much for tuning into this earnings conversation with the management of Syngene. Jonathan Hunt, as is the norm, joins us right now to talk about how the start of the year was, and does it imply in any fashion what the rest of the year could be like as well, in what is turning out to be an extremely choppy environment. Jonathan, thanks so much for joining in. If one thought that 2020 or 2021 were choppy and volatile, 2022 is turning out to be no different. In light of that, are you happy with this 8% YOY growth, even as it slipped about 15% sequentially?
Yeah, we're pretty happy. It turned out exactly as we forecast. Remember, we gave high teens or mid-teens guidance for the full year, and we said it would have some phasing to it. For us, you've got to remember just how choppy things were a year ago in the world. India was in the peak of that second wave of the COVID pandemic. An awful lot of our revenue in that last quarter was COVID-19 related. We were shipping out remdesivir. From memory, we did something like 70% of all of the remdesivir that we sold last year in the first quarter. This year, nothing. So the world's starting to come out of the pandemic. If you normalize our results for that 8% bridge through to the underlying 30% growth. So while you're describing it as choppy waters, there's clearly a good tide and a good direction for us.
So yes, you could argue that as well. I was wondering, I think at the end of the year or end of the quarter, when we were talking about how you would do, the contribution from the development and manufacturing services division was expected to drive the momentum. I'm guessing that is what's happened against the low base of the previous year.
Actually, all four of the divisions have performed pretty well. We're seeing very healthy demand across the business. The research services division is doing particularly well. I think and it's a factor we've talked about before, you're starting to see our clients, particularly in Europe and the US, they're getting back to work, they're coming out of the pandemic environment, and they're really trying to catch up on lost ground. And that's driving a little bit of more momentum in our industry. So that's healthy. We did upgrade our guidance with these results. We took it up from mid-teens to high teens. I think there's two factors there I'd call out. One is really around that good demand environment and nice sort of evenly balanced growth across the four divisions. And then the other bit's currency. A strengthening US dollar actually is a healthy environment for us. All of our contracts are priced in US dollars. As we repatriate them into rupees, it gives us a little bit of a boost on the top line. So those two factors together, unusually for us, have given us the confidence to upgrade the guidance really quite early in the year.
Yeah, and who knows, it might actually become even stronger as the year goes by. Jonathan, a word on the margins now. The decline in EBITDA margins, both sequentially and YOY, was well communicated. What I want to know is, at the end of the quarter, if I'm not wrong, you had mentioned it will be on account of step up in investments in an inflationary environment.
Yeah.
And I presume this time around you've also, when post the results, you've spoken about the remdesivir effect as well. So yeah. What led to this, and how could the quarters ahead be like?
Yeah, I actually think that the margin outlook for us is a good one. I mean, our margins are top tier industry, sort of leading if we look on a global basis for our peer group, and they're stable. So I'm happy with the outlook. On a quarter-over-quarter basis, it's much more around operational decision-making, expansions in some sales and marketing activity. Again, as the world's starting to get back to normal, coming out of the COVID environment, we're seeing more salespeople, more sales trips, more marketing and investment going in. That's a good indicator for immediate and medium-term growth. So I'm happy with those. On the CapEx side, other elements of investment in the business, we've got a big program this year, $100 million of CapEx. Half of that's going into research, and a third of that, about 30 million, is going specifically into the biologics. So there's some good investment going into the business, and for us, that's a sign of a positive medium-term outlook.
I spoke about this 10-year contract with Zoetis last week when you guys announced it. Yeah. Tell us a bit about this, because I read your comments in the release as well, and you mentioned about how this is in some ways is a landmark deal. I don't remember the words verbatim, but it seemed like a landmark deal. Can you tell us a bit about this?
Yeah, it is. It takes us actually, we cross a threshold from being a biologics manufacturer that was really focused on clinical scale support. So as you know, in our industry, it takes 7, 8 years before products finally get through to the end consumer or patient, or in this case, the animal that's being treated. So it's a long research development cycle. Most of the work we've done historically has been to support that. So it's small and medium-sized manufacturing. This takes us over that threshold into being a fully integrated commercial scale manufacturer, and with a product that looks to have fantastic potential. Zoetis is a world leader in what they do. They're an innovator. This is the first antibody. They were the first to bring antibody technologies into animal health, and this is a flagship product for them. They've launched it in Europe already. Seems to be getting a wonderful, wonderful start commercially, and they're looking to globalize that. So they're looking to take it to the US market later in the year. And we're delighted to be partnering with them and playing our part in supporting their manufacturing.
Okay. So the upping of the guidance for this year has nothing to do with the Zoetis deal, or does it?
Not really, no. We'll spend the rest of this year getting up to speed with Zoetis, getting ready to manufacture. It becomes more of a driver of the revenue from next year. This year's guidance upgrade was really the fact, as I said, healthy demand across all 4 divisions, good operational execution, and then a little bit of a boost on the top line from currency. So more to come. I think what's implied in your question is there's more to come next year.
Yeah, seemingly so, right? Because normal business continues to get traction. Zoetis will contribute in FY24 as well. And the third leg of my question is, since you mentioned that this places you in a different league now and crossing a threshold, does it mean that conversations open up for more, if not such deals, then deals of this nature, never mind the magnitude?
Yeah, I think it does, but you've got to be a little bit humble and keep your feet well grounded. We've got a lot to do. It's great to sign the partnership. I'll be much more comfortable once we're there and operating and delivering. But what it does do is it puts us on a pathway for regulatory approvals. As Zoetis takes that product and launches in many markets, of course, that will trigger regulators to come to our operations, audit them, inspect them, and hopefully find them in good order and approve them. That's really significant in our industry. Once you've got that endorsement by the FDA or the EMEA, you're in a much better position. So that's why it's got that landmark sort of feel.
Got it. Last question, Jonathan. Actually, second last question, if you will. I asked you about margins already, but I still want to just understand. There is no question mark around the growth because you've spoken about upping the guidance, which is great news, music to the ears for shareholders. What about the operational metrics? Is it too volatile an environment to be able to predict whether you'll be able to maintain at the current levels, or do you have some visibility about whether you can do that?
Yeah, I think we tend to talk about them through a business cycle. If you look at the timelines that are typical in life sciences and pharma, very volatile on the month, on the quarter, but over sort of a medium term, very, very stable and predictable margin environment. We've been sitting above 30% EBITDA for a decade or more. So at that level, it looks quite predictable. Of course, everybody's watching inflationary pressures, raw materials, how much of that can you pass through to our customers? We've been in a pretty good position so far, but I think it's a little bit too fluid for me to be calling it many quarters ahead.
Okay, got it. Final question, Jonathan, something that I'll probably ask you once every year. I asked this to you 12 months ago, that is the space that you are in. Is it at a place where maybe, say, IT services were 20 years ago, wherein the world looks to east for outsourcing of work, and companies such as yours are very well placed to take a larger slice over the course of the decade? Does that piece still continue in light of the fact that while globalization was the norm last decade, this time around it is not necessarily the case?
No, I think the thesis is still intact. Maybe where it differs a little bit towards the early stages of the IT evolution and looks more like the latter stages. It's just as likely that the work's going to come to us, but it's just as likely that we will go to them and start to globalize our own operations. Ultimately, businesses like ours, and if you look, that's a comment really on the industry. Science is done really great science is done in very, very few locations in the world, and they're all super connected. So if you think of it as a globalized industry, you've got these hotspots, whether it's Boston in the US, whether it's the UK, Switzerland, Germany, Japan, and we're adding India onto that map. But it's a connected set of scientific villages almost, and they all work together and they work globally and seamlessly.
Wow, well, that's new, and would love to explore that at some point of time, non-results conversation, Jonathan. But thank you so much for today. Lovely talking to you, and all the best for the quarters ahead.
Thank you.
And viewers, thanks for tuning in.